Good morning. We should get going. It's 11 o'clock. So I guess this week is Richard Sen from Pantheon Infrastructure. And as usual, before we get there, I've got a couple of bits of news to run through. So let's start with Greencoat UK Wind, which has announced a big buyback this week. abrdn Diversified Income and Growth, which has announced the results of its strategic review. And of course, the perennial favourite, Hipgnosis. Greencoat first. So I mean, you can see this has got an incredible track record, really. It's been going for over a decade now. It's sitting on a discount approaching 20%. That's this morning. And it's a big fund, so it's sort of over 3 billion quid. And the portfolios are going on for 5 billion, I think. And because it's 10 years old, it's been put some stats out about its track record since launch. So these were in the interims, but they've been updated in this latest announcement. So since it started, it's generated over 1.7 billion pounds worth of cash, and it's split that roughly half and half between paying dividends and reinvesting that into expanding its portfolio. And as I say, it's got a portfolio about 5 billion quid now, all invested in UK wind farms. And it's a significant player. It's generating enough power for about 2.2 million homes. It's quite risk averse. It buys only operating assets, but nevertheless, the activities that it's doing by buying projects off developers, it's freeing up capital for developers to fund new projects. So it is indirectly responsible for a lot of the developments going on in the UK. It's got a fantastic track record from an income point of view. So it's been actually improving its dividends in line with inflation, RPI every year, which is RPI is much higher than CPI. And the portfolio is quite conservatively valued. So they reckon the NAV is kind of factored in on the basis that it's going to offer a sort of 10% per annum return to investors, which is pretty attractive even in the current interest rate environment. So lots of ticks in the box. There's the 10-year track record. I think the thing I wanted to highlight on this slide here, this is the thing that these numbers are slightly different because this is at the interim stage at the end of June. The dividend cover numbers, so it's always been quite well covered. This is why it's had the surplus cash flow to invest in the portfolio, and they've been very high recently because we've had those kind of supernormal prices for power. So it's been able to use that quite effectively to build up its portfolio. You think, well, what's wrong with this then? One of the things that people always talk about is debt. That is the breakdown of its debt. It's very well diversified by where it's borrowing the money from, and also it's got quite a long profile of debt maturities, as you can see there. Some of its debt is reasonably expensive. Let's not beat around the bush. I mean, things that are priced at a margin over SONIA, which is the new thing for LIBOR, that's 6.75% is quite chunky. But when you think you're earning 10% on that, you're still making a decent margin, and it is actually doing a useful thing for the portfolio. And then some of these are very cheap because they were able to sort of fix some of the debt in the good times and for quite a long period. So that's helpful. So an all-in cost of debt about 4%. So debt's not problematic. It's not the end of the world. So even though gearing is relatively high, these are nice, safe assets, and there's some things that should be geared, especially with debt that's cheaper than the return you're getting. But what about power prices then? So what they put in the interims is this table here, which just says basically, even if prices went down to £10 a megawatt hour, they would still be generating enough money to pay the dividend. I think that's a phenomenal thing. Basically, this is quite a safe company. And from that point of view, you just can't argue there's anything really wrong with it. And there's a question there, doesn't dividend cover have to be high because the assets have a terminal value? They do have to replenish assets. This is why they keep trying to bring us that cash flow. So we don't want it to be down at 1 for a long time, but that's still the news. They could pay the dividend. As long as it's above 1, they are freeing up cash to keep reinvesting in the portfolio. So they have understandably been a bit frustrated and a bit puzzled by what's going on with the discount. And so the board said, right, we need to take some action. So the first thing that they've done is to announce what the target dividend is for next year. And they've made it 10p, which is ahead of inflation increase. And they've also bumped up this year's final. So there'll be at least a 10p paid this year and 10p paid next year. So that boosts up the yield a bit, because there are some yields in the sector that are just enormous, and it's relatively low. But on that 10p number, the yield is about 7.5, 7.6%. So really not too bad. And they're also launching a £100 million buyback program, which is kicked off, I think, and then runs for a year, so until October 2024. It didn't make any difference to the share price. And you think, well, this is just madness, really. What we've got is a really nice, safe company. It's not really fussed about where interest rates are. It's not really fussed about where power prices are going. You know, what is wrong with this? There is something wrong with the market. Why aren't there buyers of these things? And this is something that I've been puzzling over. And this week, we've been talking to a whole load of different people, to brokers and investors and all sorts of people. And we think we've come to the crux of it. So I've written an article for Citywire, I've written an article for QuotedData's that should hopefully explain all of this, but there are regulatory reasons why there's a kind of buyer's strike going on at the moment with a bunch of pressure from investors that we're hoping will get fixed. And then those buybacks and things wouldn't be necessary, and then that would have more money, free up more money to actually get the wind farms and things that we need built. There we go. So abrdn Diversified Income and Growth next. So this has been a real disappointment for investors, and there's no beating around the bush on that. You can see this is another 10-year chart. The NAV's been sort of slowly sinking away. We're not in absolute terms by an enormous amount, but still no, it's not great. And the discounts just widened out now. And it's no real surprise that the board said we need to do something about this. So there it is in the context of the rest of the flexible investment sector. Now, part of its raison d'etre is the chunky yield that it pays. Because it started off life as British Assets, it's always been an income fund. And I think there's an assumption that its investors want to keep the income. A lot of them, to be fair, have just given up and gone because this was a much bigger fund when it was British Assets, and it's shrunk to a fraction of its size. But nevertheless, that combination of income and diversified portfolio thing is relatively rare even in the flexible investment sector. And if they could get their act together, then you think there might be demand for it. But the returns have been mediocre, really. I mean, they're pretty flat, really. I know we've had a very difficult period recently, but it's not been great. What they did was they sort of rejigged everything and pushed it into private assets because they think they could get better returns there, but these take longer to mature, so there's this kind of lag effect in terms of how that feeds into the NAV. All of that's not helpful. So anyway, things to reach ahead. In June, they announced strategic review. We thought it was slightly weird that they'd done that because they'd only recently changed their strategy again, and they hadn't had enough time to bed in or for the results to come through, but nevertheless, they did do that. Then the discount was about 26%, market cap 255, and both of those numbers are gone the wrong way since. And then it had just shy of 60% portfolio in private assets, so unlisted things that they kind of locked into. In the review, they concluded that if we are forced to try and sell these things now in a hurry, we're only going to be able to do that at a sizable discount to NAV. So really, that's not a practical solution, and we could have told that before they started, but there we go. But nevertheless, they did talk to another investment trust about merging. I'd love to know who they were. We're not told that. But the board reckoned that actually none of those would actually improve shareholders' lot enough to make them worth recommending. So they've rejected that option. They do have a chunk of the NAV that will mature over the next couple of years. And when you get maturities, hopefully they get NAV uplifts, so that should all be quite good news. But that just frees up cash. So they're thinking, well, what we'll do is we'll just carry on going as we are, but we'll promise to give you some more money back. So between 30 and 35 million pounds by the end of 2024, and more in 25-26 if the discount hasn't shut. So kicking off with a special dividend of about 5 million quid in December, and then a 10 next year, assuming that it gets through its continuation vote next February. Obviously, we know continuation votes are tricky things at the moment. Yeah, so that sort of should help, I think. However, it would still have about 300 million quid's worth of assets left, assuming that the NAV doesn't really move. They reckon that the private assets portfolio matures between 2029 and 2032. Because they're going to be using the liquid stuff to fund the initial cash returns, the proportion in private assets is going to go up. But they do think there are attractive opportunities now because yields have gone up, because capital has been withdrawn from all sorts of different parts of the market. They think they can earn returns of 10-15% per annum on new stuff like green infrastructure and private credit. And they might be right, and they've got a good investment manager, they've got a good network of people to talk to. But what we're doing is sort of digging in with the private asset strategy. So if we did get to 2026 and it hadn't sorted itself out, then we wouldn't be anywhere closer to sorting the whole thing out. We just have to wait and see what happens with the markets over the time. Then, private assets are out of favour now. Illiquidity is out of favour now. It is probably a bit too small, even 300 million quid for this sort of thing. Maybe it'd be able to turn itself around. We'll just have to wait and see. And then Hipgnosis, just to finish off. I just pulled out a very short-term chart here. It's ostensibly on a 50% discount. Market cap of about 900 million quid. It had the bounce when Renhill got bought out. It fell away again afterwards. It's really not been great. The votes yesterday were quite astonishing. I mean, I know that me and AVI Global and a whole bunch of other people were going, this is daft, you can't do this. Vote against continuation, vote against the property disposal, or the portfolio disposal. But the size of the votes against are just enormous. So that it really did stir up a lot of ill feeling towards the manager. And I don't really see how their position is tenable now. The worrying thing, and this is where I put a question mark on the discount, is they did try and sell that portfolio to other parties. There was this option to do that in the mechanism thing. They did talk to 17 people. 8 of them went and had a good look at it. Only one of those made a first round bid and then changed its mind. And the board said, we didn't think we could justify paying more than the 17.5% discount price that the Blackstone fund was going to pay. That's a bit worrying, really. To me, that says the nerves are wrong. I mean, there are reasons why, but basically the way that whole thing was constructed, somebody could have gone through all of the due diligence and spent a lot of money doing all this process, bid a 10 discount, and the manager could have come in and bid 9.999% and outbid them, and that would have been because the manager had the right to refusal on this. Maybe that was the reason people didn't do it, but to me that just says the nerves wrong, and that just is another nail in the coffin for Citron Cooper, I think, because we had that ridiculous situation with the over accrual that I just can't fathom how that happened, because everything has been in the market for a long time. We talked about this before, but this is another thing that just says that this portfolio has just got the wrong NAV on it. That's going to call into question what's going on with the covenants on the debt. I think we looked at this before in June when they announced results, or July, and there was quite a lot of wiggle room in the loan to value, but it just totally depends on what the write down is. The bigger problem, the more immediate problem, has been the cash flow cover of the debt. It does raise an awful lot of questions. The board's now got 6 months to decide what to do next, and this was my argument. This was AVI Global's argument that a vote against continuation does not mean an immediate fire liquidation. This will failure. There's a long time to come up with a plan, and you can just say 5 months down the line, look, we need another 5 months. Is that okay? Shareholders and shareholders can say yes. Nothing is forced to happen now. It just means that there's a sort of line in the sand. Right. The board has been substantially slimmed down. So 2 directors just said we're not going to stand for re-election, and the chairman, as we just seen, has been ousted. So that leaves 3 directors left. I think a couple of them got relevant experience. It all makes sense from that point of view. They're going to need to bring on some additional expertise. There are a bunch of directors who are quite up to speed with how you sort out funds that are problematic like this. I know they've got a lot to do at the moment around the sector, but nevertheless, it probably needs to happen. And then we'll just watch this space. So it's a step forward and a step back, says the NAV. We'll just have to, wait and see. So that is enough from me.